Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a company that just surged from addressing, a specific, often stigmatized health concern to becoming this telehealth giant, only to then face a sudden massive challenge from a pharmaceutical titan. Can this disruptor, really a darling of the digital healthcare revolution, navigate this super high-stakes battlefield to truly define the future of health, or will it get left behind? Today, we are going to completely unpack Hims & Hers Health. We'll explore its leadership, its innovative business model, what truly gives it an edge, its financial health, and the recent developments that have sent ripples through the market. Our mission for you, our listener, is to understand what's really happening with this company and what it means for its trajectory, and for your own insights into the healthcare landscape. This is a dynamic and, frankly, fiercely competitive space, and Hims & Hers is right smack in the middle of it. To really understand where a company is headed, we absolutely have to look at who's steering the ship. So let's talk about the key individuals guiding Hims & Hers. At the very top, you have Andrew Dudum, the CEO and co-founder. He is genuinely the visionary behind their incredibly consumer-centric model. His background as a serial entrepreneur coming out of the venture studio Atomic has equipped him with this unique ability to leverage tech startup experience to normalize access to treatments that often carry, well, a stigma. What's fascinating about him is how deeply involved he remains. He's even publicly defending the company's practices on platforms like X, sometimes accusing major pharmaceutical companies of anti-competitive behavior.
Yeah, he's definitely hands-on. And that's interesting. Then there's David Wells, right, the chairman of the board.
Exactly, David Wells. His experience as Netflix's former CFO was, pivotal in guiding Hims through its 2021 public debut via SPAC, a special purpose acquisition company. His financial know-how has been key to not just scaling operations, but also maintaining profitability, which is, let's be honest, no small feat in this sector.
Absolutely not. Profitability in telehealth is tough.
And Melissa Baird, the chief operating officer, she oversees the company's automated pharmacy operations. This is such a critical piece of their direct-to-consumer model, and her background in streamlining healthcare delivery, that's been a key differentiator for him.
And that operational efficiency is core.
Finally, Mike Chi, the chief marketing officer, he's been instrumental in building that brand resonance, especially with younger demographics, through their, innovative use of social media and influencer campaigns.
Right, so you've got this team, and the decisions they've made have certainly positioned Hims & Hers as a significant innovator. Andrew Dudum's involvement isn't just, theoretical. He is deeply hands-on involved in strategic decision-making. And while Hims & Hers isn't family-owned, Dudum's entrepreneurial spirit, it really drives its disruptive ethos. His vision for making healthcare more accessible, more affordable, it aligns precisely with the characteristics you often see in those long-term outperforming founder-led companies.
Okay.
And a significant equity stake. Well, that ties his personal wealth directly to Hims' success. So his incentives are pretty well aligned with other investors.
Good alignment there.
Yeah, and this hands-on, founder-led approach, it allows them to be incredibly agile, which is just crucial in a market that moves as fast as telehealth. However, that same aggressive stance, particularly on compounded drugs, has also drawn considerable scrutiny.
Right, the compounding issue.
Exactly. Take their bold marketing approach, like that Super Bowl ad in early 2024 highlighting their weight loss offerings.
Yeah.
It definitely showcased a knack for aggressive outreach.
It got attention.
It did. But that very ad also sparked tensions regarding compounded drugs, specifically with their former major pharmaceutical partner, which raises an important question, right? Can this leadership navigate these complex regulatory and competitive pressures without alienating other key partners down the road?
That's a critical point. How they handle these major partnership fallouts moving forward, that'll be a real test of their strategic agility.
Definitely. A real test.
So with that strong, maybe somewhat provocative leadership in mind, what's their North Star? What drives the culture at Hims & Hers? What's the core mission that unites this team?
Well, the mission at Hims & Hers is actually exceptionally clear. It is to help the world feel great through the power of better health. That statement emphasizes both accessibility and personalization. Their vision is really to fundamentally redefine healthcare by systematically removing stigma and barriers.
Okay, removing barriers.
Yeah. They aim to create this seamless platform where consumers can openly, comfortably address sensitive issues. Things like hair loss, erectile dysfunction, skincare concerns, mental health challenges, and, of course, weight management. The company's culture actively fosters innovation and customer centricity. Everyone seems aligned around delivering these truly seamless digital experiences.
And looking ahead, they must have some big goals.
Oh, definitely. The leadership has articulated a significant, ambitious goal. They aim to reach $6.5 billion in revenue by 2030.
$6.5 billion, wow.
Yeah, it's ambitious. And this target is projected to be driven by aggressive expansion into new geographical markets, specifically thinking Canada and Europe. Now, while their culture of rapid execution certainly positions them well to tackle the challenges of the telehealth market, that recent high-profile split with a major pharmaceutical partner highlights a critical need for what I call diplomatic finesse.
Diplomacy.
Right, you need that when sustaining future partnerships. Their ability to innovate quickly has to be balanced with careful navigation of these important industry relationships.
Okay, that mission sounds compelling. Now let's unpack how Hims and Hers actually works. For many of us, traditional healthcare feels incredibly complex, maybe bureaucratic, but this company aims to simplify it. So how does their business model genuinely make healthcare more accessible for the average person? How do they strip away some of that complexity?
Well, at its core, Hims and Hers operates an incredibly intuitive telehealth platform. You can think of it like a digital doctor's office. Patients can easily consult licensed healthcare providers through an app, receive personalized prescriptions, and then have those medications conveniently delivered right to their door.
Okay, so the whole process is online.
Pretty much. The user journey is designed to be very straightforward. You answer a series of health questionnaires, then you connect with a provider virtually. And from there, you can access treatments for a whole range of conditions: hair loss, ED, various skincare issues, mental health support, and significantly, weight loss.
Right, weight loss has been huge for them. And that brings us to compounded drugs, doesn't it? Explain that a bit.
Yes, exactly. A critical part of their model, especially in weight management, involves these compounded drugs. For those unfamiliar, compounded drugs are basically medications created by a licensed pharmacist to meet specific patient needs. They're often used when, say, a commercially available drug isn't suitable, maybe due to allergies or specific dosage requirements.
Okay, custom made, essentially.
In a sense. But here's the tricky part. When these compounded drugs replicate patented medications, especially during official drug shortages, they fall under distinct regulatory scrutiny. This became a really significant point of contention with their former pharmaceutical partner. The process for compounded drugs, while legal, requires meticulous oversight to ensure quality and safety.
So safety and quality control is the big issue there.
Precisely. So while Hims looks incredibly simple for the user on the front end, it involves incredibly intricate back-end logistics, particularly around the regulatory aspects of these compounded medications. It's like a high-tech vending machine for healthcare looks, simple to use, but it's incredibly complex to maintain properly and safely.
That's a good analogy. So what specific products and services do they offer beyond the consultations?
They offer a pretty comprehensive suite. This includes prescription medications, a variety of over-the-counter supplements, and of course the telehealth consultations themselves. Their core offerings have truly found a strong market fit. Treatments for conditions like erectile dysfunction, often involving sildenafil, hair loss through meds like finasteride, various skincare solutions like tretinoin, mental health support, including SSRIs, and significantly weight loss treatments. That includes compounded semaglutide and even branded drugs like Wegovy, at least previously.
Okay, and the numbers back this up.
Oh, definitely. The evidence of their market success is clear. They boast 2.4 million subscribers and achieved an impressive 69% year-over-year revenue growth in 2024.
69% again, that's a strong signal.
It really is. It tells you they're effectively addressing a significant market demand. Recent launches have included branded tirzepatide, which is Eli Lilly's Zepbound, and that bundled offering with Wegovy, which was in place before that key partnership unfortunately ended. Looking ahead, their product roadmap indicates a clear focus on expanding further into mental health and chronic disease management. They even have plans to offer generic semaglutide in Canada by 2026.
Generic semaglutide, that could be big.
Potentially huge. However, it's important to note that these launches, while driving subscriber growth, do face ongoing risks from regulatory scrutiny, especially concerning those compounded drugs.
Right, always that regulatory shadow. So their product strategy is clearly evolving. Given all of that, what truly makes Hims unique in this crowded space? It sounds like they're really trying to break the mold.
Well, what truly makes Hims unique is its direct-to-consumer approach. It ingeniously blends telehealth services with automated pharmacies to deliver personalized care on a massive scale. They really excel at destigmatizing health issues, They use sleek branding and provide digital-first access that particularly resonates with the younger demographics.
Mm-hmm. The branding is very noticeable.
It is, and this model aligns very well with Jim Collins's hedgehog concept, if you know that. They're deeply passionate about making healthcare accessible. They are arguably best in class at consumer-centric telehealth, and their economic engine is powerfully driven by subscription-based revenue.
Okay, passion, best at economic engine. Makes sense.
Exactly. As a tangible example, remember their $599 per month bundled Wegovy offering? It combined the medication with 247 support. That truly set them apart from traditional pharmacies. It wasn't just a competitive price, it was a completely different user experience aimed at convenience and comprehensive support.
Right, more of a service package, and their track record overall.
Pretty impressive. Hims was founded in 2017 and has since evolved significantly from just a niche men's health platform into a comprehensive telehealth provider. Key milestones include their public debut in 2021, hitting 1 million subscribers by 2022, and achieving profitability in 2024 with a net income of $126 million.
Profitability is key.
Absolutely. Their strategic pivots to women's health in 2019 and then to weight loss drugs in 2023 were particularly pivotal. That allowed them to capitalize on the massive GLP-1 drug boom. And their revenue growth has been remarkable, surging from about $149 million in 2020 to $1.48 billion in 2024. That's a tenfold increase.
Tenfold in 4 years.
Yeah. The Super Bowl ad they aired in 2024 was a bold move, clearly aimed at capturing a larger share of the weight loss market. But as we mentioned, it also notably sparked tensions with their former partner. It illustrates both Hims' ability to adapt and its willingness to take calculated risks.
Okay. And operationally, where are they based? How do they fulfill orders?
They're headquartered in San Francisco. They operate automated pharmacy facilities in Arizona and Ohio. Those handle prescription fulfillment. Now, these facilities are leased, which effectively reduces their upfront capital expenditure, but it does contribute to higher operational costs.
Leased, not owned. Okay.
Right. And it's important to note that the company outsources some of its manufacturing to FDA-regulated compounding pharmacies. This practice became a significant point of contention in the recent dispute because it involves external suppliers and, well, their compliance.
Right, the outsourcing risk.
Exactly. Their digital operations are entirely cloud-based, which allows for immense scalability, but also, like any digital platform, exposes them to potential cybersecurity risks. And their recent acquisition of Zava, that European telehealth platform, significantly expands their international footprint. Adds 1.3 million users across Ireland, France, Germany. It signals their global ambitions.
That makes sense. So they've got their own pharmacies, but they're also relying on external partners, especially for compounding. How integrated is that supply chain really? And what does it mean for their control over their products?
Well, when we look at their vertical integration, Hims and Hers is, I'd say, moderately integrated. They maintain control over their telehealth platform and their own pharmacy operations, but they still rely on third-party suppliers for the compounded drugs they offer. This reliance means they lack direct control over the active pharmaceutical ingredients, the APIs, the core components of the medications.
Okay, so they don't make the raw ingredients.
Correct. And these APIs are often sourced from places like China. This lack of direct control was a key issue in the recent partnership dispute, as unexpected suppliers raised safety and quality concerns for their former partner. Compared to competitors like Ro, which also utilize compounding pharmacies, Hims' automated facilities certainly provide efficiency, but they do not offer full supply chain control.
Yeah.
That can impact cost stability and expose them to supply chain vulnerabilities. It's a trade-off, really, between speed and complete oversight.
A critical trade-off. And distribution. How do they get meds to people?
Their distribution model is fundamentally direct-to-consumer. Meds delivered directly via mail. This approach bypasses traditional pharmacies entirely, which enhances customer convenience and engagement significantly. They also offer that 247 telehealth support, which is a key factor in fostering customer loyalty. Provides continuous access to care.
That support sounds valuable.
It is. And the acquisition of Zava is a clear signal of their aggressive push into international markets, leveraging their digital distribution capabilities to scale rapidly. As an example of their pricing power, remember Hims was able to offer Wegovy at $599 per month compared to its traditional retail price of like $349, although the recent partnership change has, of course, disrupted that specific offering.
Right, that specific deal's gone now.
Exactly. But the scalability of their model is further evidenced by their impressive 45% subscriber growth in 2024. They're not just adding users, they're doing it at scale.
And does this translate to predictable revenue? That's key for investors.
From a revenue predictability standpoint, Hims & Hers demonstrates high predictability. Subscriptions alone accounted for over 90% of their $1.48 billion in revenue in 2024.
Over 90% from subs, that's sticky.
Very sticky. The nature of monthly memberships, like for their weight loss bundles, ensures a steady stream of recurring cash flows. That significantly enhances their financial stability. Furthermore, their long-term contracts with various pharmacies and telehealth providers bolster this predictability. However, and this is important, it's crucial to acknowledge that their ongoing reliance on compounded drugs introduces a degree of variability. Potential regulatory changes in that area could certainly disrupt this important revenue stream. So while predictable, there are still external factors that can shift the landscape.
That's a good overview of their internal workings. Now, the telehealth market is anything but quiet. So what truly sets Hims & Hers apart from the competition? What are its real advantages in this crowded space, and how sustainable are they?
Well, while Hims & Hers may not possess, true monopolistic traits, they certainly hold a strong position within the telehealth sector. That's supported by a substantial 2.4 million subscriber base. The barriers to entry in this market, things like stringent regulatory compliance and the need to build significant brand trust, do offer them some protection.
Right, it's not easy to just jump in.
Not at all. However, it's important to recognize that the market remains fragmented. You've got numerous competitors like Ro and LifeMD actively vying for market share. Hims' partnerships with regulated pharmacies historically provided a competitive advantage, but that recent high-profile split with a major pharmaceutical partner vividly highlighted vulnerabilities within those crucial partner relationships. It shows that even strong partnerships aren't static.
So partnerships can be a strength and a weakness.
A double-edged sword, exactly. Hims also benefits significantly from economies of scale, particularly through its automated pharmacies. As their subscriber numbers grow, these automated systems allow them to significantly reduce fulfillment costs. For example, processing 2.4 million prescriptions in 2024 resulted in considerably lower per-unit costs compared to smaller, less integrated rivals.
Like their pharmacist giving them an edge.
Precisely. This isn't just about efficiency. It's a fundamental process power that creates a defensible cost advantage. It allows Hims to potentially undercut traditional models long-term, provided their supply chain holds. However, it's a competitive landscape. Larger players, like Amazon Pharmacy, could potentially outscale Hims if they fully commit to expanding their presence in telehealth. That's a threat to watch.
Amazon always looms large. What about network effects? Does the platform get better as more people join?
It exhibits what we'd consider weak direct network effects, meaning the value of its platform doesn't inherently increase significantly just because more users join, unlike, say, a social network. But it effectively cultivates a soft network effect through its community-driven marketing. This is heavily amplified by social media platforms, where user testimonials frequently drive further adoption.
Like word of mouth, but digital.
Exactly. For instance, posts on platforms like X praising Hims' weight loss offerings have noticeably boosted brand visibility and attracted new users. It's a powerful engine, driven by real user experiences.
Okay, and how do they position themselves against traditional healthcare?
That's a key strategic move, their counter-positioning. The company effectively positions itself as a consumer-friendly alternative, offering remarkably affordable and stigma-free access to services. Their Super Bowl ad, for example, boldly positioned them as a disruptor, challenging what they portrayed as Big Pharma's high prices.
Taking on Big Pharma directly.
Yes, it's not just a marketing slogan. It's a direct challenge to the established order, designed to resonate with consumers frustrated by high costs and bureaucratic processes. This bold differentiation tactic sets Hims apart, but clearly comes with the inherent risk of antagonizing other potential or existing partners in the industry, as we've seen play out.
Right, that tension again. What about switching costs? Is it hard for customers to leave?
It presents a moderate barrier. There are both emotional and logistical hurdles for users who might consider leaving their seamless platform for, say, traditional providers. Think about the convenience of delivery versus going to a pharmacy.
Sure, convenience is sticky.
It is. However, competitors like Ro offer very similar digital-first services, which can reduce the friction of switching if a user finds a better offer or experience elsewhere. The subscription model Hims employs is highly effective in fostering retention, though. They have an impressive 70% of users renewing annually. This sticky revenue stream is a significant advantage.
70% retention is strong. And branding, you mentioned that earlier.
Branding is undeniably a core strength for Hims. Their sleek marketing and active engagement on social media resonates strongly with younger consumers. By focusing on destigmatizing various health issues, they cultivate a deep emotional loyalty among their user base. That, in turn, allows them to command premium pricing for their bundled offerings.
So the brand allows for higher prices.
To some extent, yes. The Super Bowl ad significantly amplified their brand recognition, but as discussed, it also drew considerable regulatory scrutiny, highlighting that double-edged sword of high-profile marketing in a sensitive industry.
Okay. Do they have any unique resources or technology?
In terms of cornered resources, Hims doesn't possess unique hard assets in the traditional sense, but they do have excellent access to specialized talent and crucial partnerships. Their automated pharmacies are proprietary, providing an internal advantage. And the Zava acquisition strategically secured a valuable foothold in the European market.
Zava helps internationally.
Definitely. However, their reliance on third-party API suppliers limits their overall resource control. This was a vulnerability clearly highlighted during their recent dispute. They can't fully control the quality or cost of those essential raw materials.
Right, the API supply chain risk.
Then there's process power. That's evident in its automated pharmacy operations and its AI-driven telehealth platform. These collectively provide significant cost and quality advantages. For example, their ability to process prescriptions, say, 30% faster than many traditional pharmacies, greatly enhances the customer experience. That represents a sophisticated process competitors might struggle to replicate efficiently. It's about consistent, high-quality, scalable delivery.
And proprietary technology, is it groundbreaking?
Well, Hims' technology is certainly advanced, but it isn't necessarily, 10 times better than competitors. Their core app and pharmacy automation are efficient, but the underlying technologies are, to some extent, replicable by well-funded rivals. However, their ongoing investments in artificial intelligence for personalized care plans could potentially widen this gap over time. That could create a more significant proprietary advantage in the future as AI becomes more central to healthcare delivery.
AI is the next frontier there. What about timing and speed?
The timing of Hims' entry into the weight loss drug market was incredibly strategic. It coincided perfectly with a significant GLP-1 boom. That gave them a crucial first-mover advantage in telehealth for these highly sought-after treatments.
They caught that wave perfectly.
They did. Their deliberate pivot to obesity treatments in 2023 allowed them to capitalize on enormous market demand. However, the recent partnership termination and the FDA's announcement about the end of semaglutide shortages directly threaten this initial timing advantage. They're forced to adapt quickly again.
So the ground is shifting under them a bit.
It is. But Hims excels in speed of execution. They demonstrated this by launching weight loss offerings within months of identifying market demand. Their acquisition of Zava, that significant European telehealth platform, within a year of identifying Europe as a key growth market, further showcases their exceptional agility.
They move fast.
Very fast. This rapid execution certainly discourages slower-moving competitors, but it also places a high demand on Hims to maintain sustained innovation and quick adaptation. They basically can't afford to slow down.
Always running. How sustainable are these advantages overall?
I'd say moderately sustainable. Their established brand and substantial subscriber base provide a significant buffer against competitive pressures. However, their ongoing reliance on compounded drugs and the inherent tensions that can arise from partner relationships could potentially erode these advantages over time. New entrants, like Amazon Pharmacy, pose a significant threat due to their massive scale. Furthermore, any new regulatory crackdowns on compounding practices could severely impact Hims' business. Technological advancements by rivals could also diminish their current efficiency lead. The recent partnership split clearly underscores the inherent risk of partner disputes, and the possibility of market saturation in the telehealth space could eventually cap their growth. Lots of headwinds, potentially.
That's a very comprehensive picture of their strengths and vulnerabilities. With all of that in mind, where does Hims & Hers go from here? What's its plan for continued growth, and how resilient is it to the challenges you've outlined?
Well, Hims' growth strategy seems to be predicated on three main pillars: market penetration, product development, and geographic expansion. They're deepening market penetration by actively expanding their subscriber base. Remember that 45% growth in 2024, and by diversifying their offerings into areas like mental health and chronic disease management.
Okay, more conditions, more users.
Exactly. In terms of product development, they're planning new medications like that generic semaglutide slated for Canada by 2026. And geographic expansion is a significant focus, as shown by the Zava acquisition, targeting Europe and adding 1.3 million new users.
Zava seems key to their international plans.
It is. The company has publicly articulated that bold $6.5 billion revenue goal by 2030. While these levers are crucial to achieving it, recent events, particularly the partnership termination, do add complexity to their weight loss growth trajectory. Navigating that is even more critical now.
So how big is the potential market they're chasing?
Hims & Hers certainly possesses significant growth potential. Opportunities abound in new geographical markets like Canada and Europe, and expanding product offerings into chronic diseases and through strategic acquisitions. While risks like regulatory hurdles and intense competition from Amazon and Ro exist, Hims' past successes, that tenfold revenue growth from 2020 to 2024, suggest a strong capability to capitalize if they can skillfully navigate the regulatory challenges.
Okay, put it in perspective. What's the total addressable market, the TAM?
All right, the TAM. The U.S. telehealth market alone is projected to reach an astounding $460 billion by 2033. Weight loss drugs could contribute maybe $100 billion annually to that. Hims' specific TAM covering men's, women's health, mental health, obesity care could potentially reach $200 billion by 2030.
$200 billion, that's huge.
It's massive. With their current 2.4 million subscribers, Hims captures a relatively small but steadily growing share. This indicates substantial room for expansion, particularly internationally.
Lots of runway then, and the applications of their platform.
The applications are broad and diverse, spanning men's health, women's health, mental health, obesity care. The inherent flexibility of their platform significantly enhances its scalability, allowing them to address a wide range of conditions efficiently. For example, their mental health offerings are tapping into a global market estimated at $280 billion. Considerable potential for expansion there. They're not just a one-trick pony.
Good diversification. What about supply chain diversity? You mentioned the API risk.
Yeah, that's an area for improvement. Hims is moderately diversified. While they primarily rely on U.S.-based pharmacies, their sourcing of APIs from China has been a vulnerability, as highlighted in the recent dispute. Mitigating these risks would involve diversifying their suppliers or actively seeking FDA-approved APIs from a wider range of sources. Some competitors like Ro seem to be moving more towards domestic suppliers already. This is a critical area for Hims to shore up.
Definitely needs attention. How diverse is their customer base?
Remarkably diverse, actually. Includes individuals from young adults to seniors, caters to both men's and women's health needs. Their 2.4 million subscribers reflect a broad demographic appeal, which reduces reliance on any single segment. Plus, their geographic expansion into Europe will further diversify their customer portfolio, spreading risk and opening new avenues for growth.
Okay. Looking long-term, how durable are their services? Will people still need this in 10, 20 years?
Regarding longevity, the services Hims provides are highly likely to remain relevant. I'd put the probability of sustained demand at around 90%. That's driven by powerful secular trends like the widespread adoption of digital healthcare and, unfortunately, the rising rates of obesity globally. Healthcare, by its nature, is generally recession-resistant, so Hims products can typically weather economic downturns.
90% chance of relevance seems high.
It does, but the trends support it. However, it's crucial to acknowledge that ongoing regulatory risks and intensifying competition could certainly challenge this longevity over the long term. The key drivers of Hims' continued growth are clearly subscriber growth, successful new product launches, and their strategic international expansion. Zava and generic semaglutide in Canada are tangible catalysts expected to fuel future growth.
And the main risks again, just to summarize.
The main risks are potential regulatory crackdowns on compounded drugs. A major concern given weight loss is maybe 40% of revenue. Intense competition from giants like Amazon and DTC models like Ro partner disputes, as we saw. And finally, the possibility of market saturation in telehealth eventually capping their growth potential. They need to keep finding new areas.
Beyond the company itself, the broader economic environment always plays a role. How do macroeconomic factors and its current financial health look? Does the financial picture reflect the growth story you've been painting?
Macroeconomic factors certainly have an impact. For instance, rising interest rates increase their borrowing costs, especially for things like the Zava acquisition, which might use debt. Higher rates could also potentially reduce consumer spending on more elective treatments, hitting revenue.
Consumer spending is key.
It is. In terms of trade, global dynamics impact Hims' supply chain, particularly their reliance on APIs from China. Tariffs or restrictions could easily raise costs that came up in the dispute over uninspected suppliers. Inflation is another factor. It can squeeze profit margins if API costs rise faster than they can adjust subscription prices. Persistent inflation could also soften demand for premium services, like their weight loss bundles, if it erodes disposable income.
Okay, rates, trade, inflation. What else?
Crucially, the telehealth regulatory environment. This is paramount. Potential FDA crackdowns on compounded drugs may be anticipated in 2025, directly threaten HIM's weight loss segment. Right? Remember, that's 40% of total revenue. Skillfully navigating these regulations will be absolutely pivotal. A significant shift here could fundamentally alter their trajectory.
Regulatory is the big one then. Now let's look at the current financials. How are they actually performing?
Okay, the numbers. HIM's reported $1.48 billion in revenue for 2024. That's a substantial 69% year-over-year increase, driven primarily by subscriber growth and their strong weight loss offerings. Their guidance for Q1 2025 projects revenue between $2.3 and $2.4 billion. That would represent a remarkable 55% to 62% increase. That level of growth is truly impressive for a company their size.
Huge top-line growth. What about profits?
Good question. HIM's achieved a net income of $126 million in 2024. That yields an 8.5% margin, reflecting their improved operational efficiency. Their adjusted EBITDA stood at $177 million, or 12% of revenue.
Okay, so profitable now.
Yes. And when we combine their 69% revenue growth and 12% adjusted EBITDA margin, HIM's achieves an impressive Rule of 40 score of 81.
Rule of 40. Remind us what that means.
Sure. It's a common metric in tech. If a company's revenue growth rate plus its profit margin EBITDA here adds up to 40% or more, it's generally considered healthy. HIM's score of 81 signals exceptional product market fit and operational efficiency. They're growing fast and managing to stay profitable.
81 is very strong then.
Very strong. Their return on equity, ROE, was 15% in 2024. Demonstrates efficient use of shareholder capital. That's a significant improvement from previous negative ROE figures, showing they're now generating real value for investors.
Good turnaround on ROE. What about cash and debt?
They show strong liquidity, current ratio of 2.5. They hold $220 million in cash and a manageable $100 million in debt. Their debt-to-equity ratio of 0.2 is notably low. That provides significant financial flexibility for future investments or to weather challenges. Furthermore, their free cash flow saw an 80% growth to $150 million in 2024, driven by ongoing operational efficiencies. This cash generation is critical for funding their ambitious expansion plans without relying too heavily on external financing.
Strong cash flow is always good to see. Any other key metrics?
Yeah, company-specific ones continue to paint a positive picture. Subscriber growth hit 45%, bringing their total to 2.4 million users, and they boast a robust 70% retention rate, highlighting strong customer stickiness. When compared to peers like Roe, which has an estimated $800 million in revenue, and LifeMD maybe $200 million, HIM's $1.48 billion revenue and its established profitability clearly stand out. Its 8.5% net margin also exceeds Roe's estimated 5%. Makes it a leader in both scale and financial performance among its direct telehealth rivals.
So, leading the pack financially, what are the overall trends?
Revenue and subscriber growth have consistently accelerated since 2021. However, it's important to note that margin expansion did slow down a bit in Q1 2025. That's largely due to increased regulatory costs and the significant investments they're making. And of course, the recent partnership termination could also exert pressure on revenue growth if weight loss sales experience a significant slowdown. That's a key area to monitor going forward.
All these moving pieces bring us to what's happening right now. How are current events shaping the narrative around HIM's and hers? And what does it all mean for its valuation? This is where the rubber meets the road for investors.
Definitely. Several current and upcoming events are significantly shaping the narrative. The termination of that key partnership in Q2 2025 was a major blow. It caused a sharp 35% drop in HIM's stock price, a clear market reaction to losing a significant supply channel.
35% drop. Ouch.
Yeah. But on the flip side, their acquisition of Zava, the European telehealth platform, also in Q2 2025, added 1.3 million European users. That's considered a significant potential growth catalyst. It signals that HIM's is quickly pivoting and expanding beyond its domestic challenges.
So a negative and a positive event close together.
Right. Looking ahead, investors should closely monitor the Q3 2025 earnings report, scheduled for August 4th. This will provide crucial updates on their weight loss revenue performance post-partnership changes and their ongoing efforts regarding regulatory compliance, which remains a central theme.
August 4th. Got it. What's the general feeling, the narrative around the stock now?
It's quite mixed, actually, particularly if you look at discussions from individual investors on platforms like X. On one hand, you have the bull perspective. These investors highlight the, estimated $46 billion TAM opportunity and the potential for tenfold growth, often citing that impressive 86% revenue growth. They see HIMSS as a disruptive force that's just getting started.
Okay, the bulls see huge potential.
Then, conversely, the bear perspective expresses significant worry about regulatory risks and the fallout from the recent partnership termination. They even fear potential legal action. They view HIMSS's business model, especially its reliance on compounded drugs, as vulnerable. The dominant narrative seems to be one of, I'd say, cautious optimism. Investors acknowledge the growth potential but remain concerned about the practices around compounded drugs and the intensifying competition. It's really a battle between opportunity and risk.
Opportunity versus risk. That sums it up well. Let's dive into valuation. Where does the stock stand now and how volatile has it been?
All right, valuation. Let's get a snapshot. As of the close, on July 22, 2025, the stock price is $50.01. This gives him a market capitalization of roughly $11.194 billion. Positions it as a significant player in telehealth.
11 billion market cap. Okay.
But this price is not static. It's the result of a truly volatile journey. The stock has oscillated dramatically. It hit a 52-week high of almost $73 during that GLP-1 weight loss frenzy and dipped to a low of around $13.50 when regulatory uncertainties loomed large.
Huge swings there, $13 to $73.
Massive swings. Recent trading volume has been robust, over 22 million shares, signaling heightened investor interest or perhaps anxiety amid the recent partnership fallout and broader market shifts. This current price point, $50.01, it's more than just a number. It represents a battleground where optimists see untapped potential and skeptics see overvaluation, all tied directly to whether HIMSS can effectively reinvent itself post-partnership and fend off aggressive competitors.
So why is understanding valuation so critical for our listeners, the individual investors?
It's critical because for you, valuation is not academic jargon. It is the compass that guides every informed decision. It answers that fundamental question: is HIMSS and HERS overpriced hype, an undervalued gem, or a fairly valued steady performer? Understanding valuation helps prevent the classic trap of buying high on euphoria like during that GLP-1 boom and then selling low in panic like during the post-partnership dip.
Avoid buying high, selling low. The classic mistake.
Exactly. Company managers also use valuation to allocate capital efficiently, avoiding situations where flashy growth masks eroding fundamentals. In the context of HIMSS's future, valuation profoundly matters because it quantifies the company's ability to lead. If the stock appears undervalued, it signals market doubt about its resilience, potentially offering a buying opportunity for believers. Conversely, if it's overvalued, it might foreshadow the company being overtaken as inflated expectations crumble. Ultimately, mastering valuation empowers you to distinguish genuine signals from mere noise. It transforms this telehealth battlefield into a calculated strategy rather than just a roll of the dice.
Okay, crucial tool. How do we actually value HIMSS? What methods work best?
Valuing HIMSS requires a multifaceted approach. We need to thoughtfully blend intrinsic and relative methods to truly capture its high-growth, disruptive nature. First, let's consider the gold standard, discounted cash flow or DCF analysis. This intrinsic method projects future free cash flows and discounts them back to their present value. For HIMSS, we begin with their strong 2025 revenue guidance that $2.3 to $2.4 billion, representing 56% to 63% YoY increase, and their adjusted EBITDA projections of $295 to $335 million, with margins of 13% to 14%.
Using their own guidance as a starting point.
Right. Then we assume a conservative growth tapering to, say, 35% annually over the next 5 years, aligning with subscriber expansion and international pushes like Canada in 2026. After that, we project a terminal growth rate of maybe 5%, reflecting a more mature phase. Now, when we factor in the inherent risks like those regulatory hurdles around compounded GLP-1s and project their future cash flows, our analysis, based on early 2025 data, suggests that the company's true value might be closer to $60.24 per share.
So potentially some upside from the current $50.
Potentially, yes. But sensitivity is key. If we increase the discount rate to 12% to factor in heightened competition risk, the intrinsic value drops to around $45. Conversely, an optimistic 40% annual growth assumption could push it to $70.
So the assumptions really matter.
They matter hugely. This DCF method is particularly effective for HIMSS because it directly accounts for the long-term cash generation from their subscription services, over 90% recurring revenue. But it absolutely demands meticulous scrutiny of all underlying assumptions. Overly rosy projections could easily overlook the impact of that partnership void.
Makes sense. What about comparing HIMSS to its peers? Relative valuation.
Good point. Relative valuation provides that peer comparison lens. Benchmarking HIMSS against rivals like Teladoc, the privately held Roe, and LifeMD, HIMSS currently trades at a forward price to earnings, or PE, ratio of 82.64. Now, that is quite high compared to Teladoc's PE of 25.
82 PE, that sounds very high.
It does sound high. What it means for you is the market expects a lot of growth from HIMSS. This high PE is somewhat justified by HIMSS's projected 174% earnings per share growth forecast for 2025, especially when Teladoc is still losing money. So the number looks high, but the growth projection explains it. Their enterprise value to EBITDA stands at 82.67. That's also a premium compared to peers ranges, maybe 20 to 30. This premium reflects HIMSS's significant profitability turnaround with that $126 million net income in 2024.
Okay. Premium multiples reflecting growth and profitability.
Exactly. A PEG ratio of 5.23 indicates that much of their projected growth is already priced into the stock. For context, a PEG closer to 1 often suggests fairly valued growth. So 5.23 implies the market has very high expectations for HIMSS's future earnings.
That's a lot to consider. With all those numbers and with such high growth expectation priced in, let's go directly to the heart of the matter. What are the strongest arguments for and against HIMSS and HERS right now? I want to hear the most compelling case from both sides.
Right. To truly grasp HIMSS's valuation, it's essential to steelman both the bear and bull theses, meaning construct the strongest possible arguments for each side, drawing from analysts, retail investor discussions on Reddit, X, expert reports, everything. This dual perspective illuminates why the stock trades where it does and ties directly back to that central question. Can HIMSS lead, or will it be left behind?
Okay, lay out the strongest bear case first. Why might HIMSS fail?
All right, the bear thesis in its strongest form. Bears argue HIMSS is essentially a house of cards, significantly overvalued at $50.01, with fundamentals crumbling under the weight of that partnership termination and relentless competition. Institutional firms like Citi, FJ Research have highlighted the abrupt end of that partnership as a potential death knell for HIMSS's crucial weight loss segment, 40% of revenue. They point to HIMSS's reliance on compounded GLP-1s, especially as FDA shortages are ending. That potentially exposes the company to lawsuits or even outright bans.
The compounding risk is central to the bear case.
It's absolutely central. Valuation metrics, according to bears, scream bubble. Trailing PE of 73, forward PE over 82, PEG over 5 signaling growth isn't worth the price. Their relatively thin net margins of 8.5% and a high short interest 37.92% of the float reflect deep skepticism. Bears contend these margins could erode further if API costs spike or if HIMSS has to dramatically increase marketing spend to replace that lost supply.
So margin pressure is a big concern too.
Huge concern. Competition is seen as ferocious. Amazon Pharmacy Scale, Rose's similar DTC model, Big Pharma's direct plays like Lilly's Zepbound Push. They all threaten HIMSS's market share, particularly because HIMSS is perceived to lack deep moats like unique tech or patents. Retail investor sentiment often echoes this gloom. On places like Wall Street Bets, mid-2025 posts lament the Novo divorce as a red flag. Some call it an overhyped meme stock, destined for a 30% drop, citing regulatory risks and potential subscriber churn if prices rise post-compounding. X-threads amplify fears of big pharma retaliation, predicting market saturation in a telehealth TAM that, while large, sees HIMSS holding maybe only a vulnerable 0.5% share. Overall, bears view HIMSS as a fad-fueled rocket destined to crash, trading at a premium that ignores the erosion of its advantages.
Okay, that's a compelling, if worrying, bear case. Now give me the strongest bull argument. Why might HIMSS soar?
All right, the bull thesis, equally strong. Bulls counter that HIMSS is fundamentally undervalued, acting as rocket fuel poised for explosive growth despite the recent hiccup, making $50.01 under bargain given its disruptive prowess. Institutional proponents like Morgan Stanley, Zacks Equity Research highlight robust financials, projected 58% revenue growth to $2.3 billion in 2025, a massive 174% surge in EPS, adjusted EBITDA margins hitting 13-14%, demonstrating clear operational leverage.
So the numbers look great to the bulls.
They do. They argue the partnership termination is merely a short-term blip. HIMSS has already shown agility by pivoting to generics like the planned Canada semaglutide launch and exploring branded alternatives. This strategic shift allows HIMSS to still capitalize on that massive $100 billion obesity market, where demand continues to outstrip supply. The strength of its subscriber base is also core. 2.4 million users, growing 45%, driving 90% recurring revenue, with 70% retention, underscoring exceptional customer stickiness.
The subscriber base is key for the bulls.
Absolute key. Strategic expansion initiatives like the international push via Zava adding 1.3 million Europeans and their development of AI tools like MedMatch position HIMSS as a leader in precision care, not just a pill distributor. Valuation, for bulls, strongly supports their case. DCF models indicate fair value around $60.24, implying 20% upside. A price to sales of 6.76 is considered reasonable for peers with similar 60% growth. On Wall Street Bets, retail bulls praise HIMSS' quiet revolution in healthcare. Posts from 2025 highlight discrete prescriptions, GLP-1 tailwinds, with users predicting 100% upside to $100 based on monetization. X sentiments are predominantly positive, praising execution speed and the ambitious $6.5 billion 2030 revenue goal. They view competition not as a threat, but as market validation. They believe HIMSS' brand loyalty and DTC edge will let it consistently outmaneuver even giants. Ultimately, bulls firmly believe HIMSS is poised to lead, currently undervalued amid short-term noise.
Those are incredibly well-articulated arguments. You've outlined a compelling bull case, but I keep coming back to that 30% risk you mentioned, FDA clampdowns, intense competition. Given that, what's the single biggest factor that could truly shift your 70% probability towards HIMSS being left behind?
Okay, weighing all the evidence. The bull thesis for HIMSS and hers certainly appears the most probable outcome. Their consistent track record of beating estimates like 111% revenue increase in Q1 2025, coupled with the profitability turnaround and strategic pivots like Canada generics and Europe expansion, all suggest resilience and adaptability. However, the regulatory and competitive risks highlighted by the bears do temper this optimism. That leads to a cautious bull stance. I'd assign, a 70% probability of HIMSS continuing its leadership trajectory, assuming consistent execution, but there is still that 30% chance of them being passed. The biggest factor that could shift HIMSS into that 30% probability of being left behind is indeed a severe, broad regulatory clampdown on compounding practices.
A regulatory hammer.
Exactly. If the FDA moves beyond warnings and shortages to outright bans or extremely stringent new requirements on compounded GLP-1s, that could cut into nearly half their revenue stream almost immediately. That would shake investor confidence and force an even more dramatic, difficult pivot. At its current price of $50.01, HIMSS trades at, I'd say, a modest discount to its intrinsic value. DCF models peg fair value over $60, implying maybe 20% upside. While relative multiples align with growth peers, they arguably undervalue the subscriber moat in international catalysts. This provides a margin of safety for investors betting on HIMSS post-partnership leadership, but it certainly demands ongoing vigilance. Any earnings miss or negative regulatory news could quickly shift it into overvalued territory.
So after exploring every facet of HIMSS and hers, from its daring leadership to its financial health, let's bring it all back to that big question we started with. Can HIMSS and hers health truly lead the charge into the future of healthcare, or will it be left behind by the bigger players or the nimble newcomers?
My informed opinion is a resounding yes, it can lead. But it won't be a cakewalk. I'd peg the probability at 70%, grounded in the company's strategic agility and core strengths. The recent partnership termination, for example, is a setback, not a knockout blow. HIMSS' swift pivot to FDA-approved generics like planned generic semaglutide in Canada by 2026 and their continued offering of branded alternatives like Zepbound bundles effectively fills the void. This allows them to continue tapping into that $100 billion obesity market where demand still outstrips supply.
They're adapting to the partnership loss.
They are. Quantitatively, while weight loss treatments drove 40% of 2024 revenue, it's crucial that their non-GLP-1 segments grew by an impressive 43%, hitting 2025 targets early. Subscriber stickiness is another undeniable strength. 2.4 million users, 45% YoY growth, 70% retention. These figures fuel over 90% recurring revenue, providing a significant cushion. While competition from Amazon Pharmacy Ro, LifeMD is certainly present, HIMSS' brand resonance, particularly how they destigmatize sensitive issues via marketing like the Super Bowl ads and their exceptional execution speed, like the Zava acquisition adding 1.3 million Europeans, create a significant edge.
Brand and speed are key differentiators.
Key differentiators. Financially, the company is resilient. 126 NIBR net income in 2024, 177 stable adjusted EBITDA, strong 2025 guidance projecting $2.3 to $2.4 billion revenue, 58% growth, and $295 to $335 million EBITDA. Plus, secular trends like digital health adoption and the obesity epidemic continue to propel HIMSS forward. Even some peers struggle.
Okay, so a cautious yes, they can lead. What are the key takeaways or truths for individual investors trying to understand this?
From a first principles perspective, understanding the core truths about HIMSS and hers can provide you with an asymmetric information edge. Truth number one: healthcare's fundamental problem is access. HIMSS directly addresses this through its DTC telehealth model, aligning incentives via subscriptions that reward retention over one-off transactions. And here's a piece's asymmetric information. While headlines obsess over partnership issues, HIMSS' proprietary data trove from 2.4M users powers AI tools like MedMatch. This tech can predict user needs far more effectively than rivals. That's often undervalued in models and could realistically boost average revenue per user by maybe 20–30%.
So their data and AI is an underappreciated asset.
Very possibly. Truth number 2 is the profound edge of a founder-led company. The CEO's significant equity stake, over 10%, directly ties his fate to yours. This alignment drives bold moves, like expanding into generic markets where competitors lag.
Founder-led drive matters. What about the risks again, the known unknowns?
Right, the key risks, the known unknowns. Major one. Regulatory clampdown on compounding. FDA could extend shortages or impose bans, potentially slashing revenue. Monitor upcoming earnings for clues. Another is intensifying competition. Amazon's pharmacy push could erode market share. Track HIMSS customer acquisition cost payback currently under 1 year as a key health signal. Finally, partner volatility. More terminations possible if Big Pharma views HIMSS as a threat, impacting supply and access.
And the really unpredictable stuff, the unknown unknown.
The unknown unknowns. Key uncertainties. These include black swan events, like a sudden global API shortage from geopolitical tensions and maybe new tariffs impacting China. Another uncertainty. Breakthrough tech, revolutionary AI diagnostics from startups could potentially render current telehealth models obsolete. Lastly, significant demographic shifts. If, say, Gen Z health trends pivot away from certain treatments after the current GLP-1 fatigue, HIMSS' product roadmap could crumble.
Always uncertainties out there. Any final tips for individual investors looking for an edge here?
A few things. First, delve into proxy statements. They often reveal how leadership compensation, especially the CEOs, is tied to subscriber growth, aligning incentives. Second, keep a close eye on short interest. With 37.92% of the float short, positive news could trigger a short squeeze, leading to potentially significant stock appreciation as shorts cover.
High short interest could mean volatility upwards too.
Potentially, yes. Third, consider the undervalued international play. Zava's European foothold targets a massive TAM. Early metrics from this expansion are already showing faster growth in U.S. operations, a signal of future potential often missed by the broader market.
HIMSS and Hers isn't just a company. It's a living case study in how innovation, disruption, and rapid adaptation play out in one of the most vital sectors of our economy. Its journey highlights the immense potential and the very real pitfalls of transforming a traditional industry. So for you, our listener, the question isn't just about whether HIMSS and Hers will lead, but what lessons their story offers for navigating disruption, assessing risk, and finding value in a constantly evolving landscape. Thank you for joining us on this exploration. We hope this has given you a truly well-informed perspective.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.